Welcome to the Decentralized Podcast, where we break down the world of Web3, digital assets, and DAOs with me, your host, Pietri Basson. In this episode of the Decentralized Podcast, we have a conversation with Zoe Wyatt and Ben Lee, who are both partners at Andersen LLP. Ben and Zoe are really at the cutting edge when thinking about taxation when it comes to tokens and token projects, and we cover a lot in this episode in terms of what to look out for, what teams don't consider. I'll be honest, I went back and re-listened to a bunch of pieces in this episode and sent little snippets to our team for things that they should be looking out for. So I really hope you enjoy this episode. So Ben, Zoe, thank you very much for joining me. Really looking forward to talking to you guys.
Thank you for having me.
We've done the intro and everything. We usually kick off somewhere a little bit different. Ben, I wanted to start out with a 286 and a 386 computer and learning how to fix that.
You have done your research.
Yes. So, can you, well, for some of the folks who don't know who that is, I grew up with a 286.
Did you?
At least I know.
Right. It's worrying that people now don't know what even a 086 or 286 are. But yes.
So how did you sort of get into tech? How did you learn how to fix computers?
Yeah, so my dad worked, he worked for ACL, which eventually merged for Fujitsu, but he used to bring home these PCs for us all to use as like a family computer. And obviously being a young boy, I wanted to play games on them, right? So you'd use DOS, you'd have to install it. Some people might know what DOS was, but that was sort of the command prompt and operating system at the time. And invariably there'd be different memory requirements and various other things going on. And I'd had to change certain settings to get the games that I wanted to run to play. And then it was always a case of understanding what those settings were, putting those settings back. Didn't have too many hardware issues at the time. That came later when, in the days of sort of Pentiums and graphics cards, and then understanding how sort of the motherboard and everything else works in the PC. But at quite an early age, I did get into basic programming. So yeah, I would be doing all sorts of things and trying to print things out on like the dot matrix printer from Yoshi. It was just a fascination, and that's never really sort of gone away. And then as we got older and we had all these sort of legacy machines, I'd have one in my bedroom that I would just continue to sort of just play with and test its capabilities, basically. So that's my very nerdy upbringing.
That's it's a cool way. I mean, it means you understand things at a very fundamental level.
Yeah, I think I've just retained that. I mean, I don't do as much of it as I would probably like to, but certainly the sort of the programming language and how that's developed. And I got into a bit of sort of C++ at school. Now Python is mammoth, and I wish I had the time to even master anything that fast. But it does obviously then come into use to some extent with what we're doing now, although AI is rapidly changing the need to understand a lot of this code. But yeah.
Okay, awesome. And then, I mean, you sort of had that techie background already. When did you get introduced to the crypto side of things?
So it was really interesting. I was having conversations with some colleagues in sort of 2015, 2016. One of my colleagues was just sort of given 10 Bitcoin back in the day, and it sort of sparked a lot of, sort of conversations. Sadly, I think he got rid of them before they actually ever became of any real value. But we started having these conversations, and I started reading up more around blockchain and cryptocurrencies at that point in time. Read Blockchain Revolution by Dan and Alex Scott, which was a really good introduction. I think that was sort of around 2017, and started really sort of thinking, hang on, this is a technology and what that can bring to the table in terms of, the immutable ledger, what that means for sort of financial transactions. It sort of got me hooked on a personal level. It wasn't until around sort of 2019, 2020 that sort of started actually offering this as a service, i.e. trying to actually engage with individuals and businesses around this, because it was definitely something people were quite refrained from speaking about. Again, it's sort of, whether that was just the public perception still that crypto was a dirty word, and trying to bring people more to the front. Go, actually, it's okay, and you can even talk to an accountant about it. I think people were very wary of either disclaiming that they were into that sector or worried I was probably going to tell them they needed to pay tax. One of the two. I will let the audience decide which one it might have been more, but it's so and then since then basically been operating in this space with clients both in an individual capacity and a business capacity, doing some wonderful things within the space.
Very interesting. So I'm going to throw it over to you. I mean, you were doing international property deals, etc. When did you come across crypto, and how did you get introduced to it?
So my mum was actually a programmer at IBM for like her entire career, and we had Amstrad and all the PCs at home.
How are we learning this?
And I, because I never looked at it. I used to play a game called Digger, and that.
Oh yeah, awesome!
Oh my god, Digger was so great. I spent my entire time trying to beat my mum's score. She's full obsessive, and never beat her. I came close. So yeah, I did. Mine wasn't in the same way as you, but I, as an international tax specialist and advising across multiple jurisdictions, you're a problem solver. And we used to do a lot of kind of fun planning with arbitrage on different tax laws and double tax treaties. And then in 2015, the OECD produced this project called base erosion and profit shifting. And essentially it stopped all of that fun. So from 2015 onwards, international tax became boring, and it was tax risk management. So I was bored. I was like, where do I go from here? Like, this is not something I'm interested in. And then we had a couple of ICOs come in 2017. So I did real estate until the real estate crash in 2008. And then we were doing loads of multi-jurisdictional real estate funds. So we had to kind of reinvent ourselves again then, because there was no work. And I ended up going to Acer, the computer distributor, and I was doing their kind of global transfer pricing and international tax. I didn't like working in-house. I learned a lot from the client side, but I wanted to work with more companies like Acer, not just one company. So I went back into practice, and then I started advising mainly technology companies. So they all had some weird IP and something new, and we had to think about how to exploit it. And so between 2008 and 2015, I offshored loads of IP to multiple jurisdictions. And then you have to understand how the IP is being exploited to work out which country you can put the IP in, because you could have the IP in, say, BVI, before economic substance. And if you wanted to license it, if it was being licensed, you would then say to the US, for example, you then have withholding taxes, so big withholding taxes. So you need it to be in a treaty country. So I did a lot of that. And then in 2015, with the OECD's base erosion and profit shifting project, you just couldn't do it anymore. You couldn't transfer IP out. It'd be deemed to belong, there'd be exit taxes, or income would be deemed to belong to the onshore country. So as I was saying, I got bored. It was a tax risk management role. And then a couple of ICOs came in 2017, and everyone was like, Zoe likes the weird IP. So, and I can't even remember the names of them. It's so long ago, and I'm pretty sure they're not around. We did them out of Hong Kong. It was the first time I was having to go, okay, what is this? How does it work? And for me, I wasn't excited about blockchain or what they were doing. I was just like, how are you making money from this? So for me, if you've got IP, and how to kind of tax structure it, we have to understand, like, how are you exploiting it? And so that was the only thing I cared about. But in trying to get to that answer, I had to learn about blockchain and tokens and how it worked. And so I think I read Blockchain Revolution around the same time. But then no more of that work came in. I think around 2017, 2018, we then had the crypto winter. But then I could see things picking up. So in 2019, I studied blockchain strategy. And then just completely coincidentally, we were working with a guy from Outlier Ventures, and we were moving him to Spain under the Spanish expat regime. And he and I were talking, and I said, I'm studying blockchain strategy. And then 4 weeks later, he referred me my first client. And then I've been full-time in Web3 since then. So we pretty much serviced every project that came out of Outlier from like 2019 till the crash, really. So.
And how hard was it to actually start building that business? Because I'm sure the partners in the firm were, this is all going to disappear, etc. I remember having those.
Yeah, it's interesting because I joined, so Andersen we created in the UK in 2019. And so there were only 6 partners at the time. We had probably 4 employees. We're now 12 partners, 50 plus employees. So actually there was a lot of flexibility, and So yeah, everyone was like, just go for it. We didn't really have any issues. And then because, so 2019, projects were still struggling to, say, issue a SAFT. Like investors were like, we want token warrant, and we want equity and token warrant. And then within 3 to 6 months, so by the March, that had completely flipped. Like no one was interested in equity. So in that kind of 6-month period, it just went nuts, like the volume of work that came in. And then that lasted right through till May 2022.
Okay, very interesting. Ben, I'm going to throw it back over to you. You had a bit of an interesting journey getting to becoming a chartered accountant, and you're a CTA. So you did chemistry before.
I did.
What made you decide to go sort of the accounting route? And then how have you found that accounting to be applicable in what you're doing these days?
That's a great question. I wish I had a genuine answer for you. Like I always joke that I left university. Well, no, when I was getting to the point before leaving university, they sort of give you this job book of things you can go and do. And I sort of opened it up and got to like accountancy, and it was a really big book and I never got any further. I just thought, fine, I'll be an accountant because I don't know, if I went back to sort of 7-year-old me and I said, hey, you're going to be an accountant when you're older, I think I'd look at myself and go, really? And then be interested in quite how my life got to that point. But yeah, I think honestly, so I really enjoyed chemistry. I do consider myself to be quite institutionalist. I liked taking exams, accountancy, and certainly the tax qualifications were able to give that to me, and I enjoyed studying and going through that progress. Now, I am very lucky in that that background has kind of led me to where I am now, because I before getting interested in this sector, I had some tech clients, but not a huge amount. A bit like Zoe, I was involved on the property side of things up until around 2016, and then I was sort of more general practice. But then when I was then getting this interest in blockchain and crypto, it was this sense of, hang on, you've got something here it's new. We've got a new asset class. How does this all work? How does this fit into tax legislation? What is this for accounting purposes? And it's very unusual, I think, for, I would say, people or other accountants out there to suddenly not know how to deal with something that's not, we're quite happy. We sit in our lovely little boxes and we tick things over and we know what's going on. And newness excites me in general. So I feel very privileged and lucky, I think, because of my interest to have actually gone, well, I want to understand this. Let's get engaged with this. At the time HMRC started doing some working groups, and I was involved with those to try and understand this more and what other people's take on this as an asset class was, and try to then build an understanding of this sector to be able to service clients. So like most things in life, I think it's luck and being in the right place at the right time.
Well, I think it's a certain personality, because I've dealt with the accounting, and you have to go back to first principles.
Absolutely.
And a lot of people, there's just way you want to do it. They don't want to almost go back to that. And I'd agree with you. This was interesting.
Yeah.
This was actually cool. Let's figure it out. Let's really get into it. Some people want to do that and really figure it out, get into it.
Yeah.
And you need that kind of personality when you're working.
Absolutely. And I do think, because of the industry, because it is quite techy, because there is almost, I think we realize, because we sit in our little echo chamber, but the terminology and the language that we use is quite off-putting to many in terms of a barrier to engagement. I know there was a recent study, I think in the UK, saying I think only 9% of accountants were looking at upskilling in cryptocurrency. And I think that's simply because of the understanding that you need and the passion that you probably need in the sector. To really go, well, there's a lot of unknowns here, as you say, let's go back to first principles and let's figure this out.
Awesome. So I think it's really interesting, because you're in an industry that's very male dominated, even just in law firms. And in crypto, it's also very male dominated.
Yeah.
How have you found as a woman working in the crypto industry?
My entire career has been around men, working in real estate and then tech companies. I probably experienced more female interactions in crypto than I have in the others, particularly because our source of work would come from banks and then from corporate service providers in, say, the Channel Islands, all male dominated. All the social events we would go to, the networking events, all male dominated for years. So I actually see more women on the kind of legal side, the intermediary side, in crypto than I have any other part of my career. That's not to take away from the fact that there are not enough women in crypto.
Do you think that's because it's new, there's almost a chance to rebuild it from scratch and there's more women? I know there is still not enough women in this space.
I think from a intermediary perspective, a lot of men already have their careers. A lot of men already have their careers. So I think you probably need to be relatively senior to be able to then take on a new asset class like crypto. So you've got to have that good experience. And usually the men are already the partners and in the senior roles. So I think if I look at the female intermediaries like lawyers, corporate service providers, more the lawyers, they have maybe been at director, maybe they're director partner level, but they've been able to take that opportunity and run with it and actually further their careers with it. Also think women are better problem solvers. And I think you have to be, I mean, I don't know if I'm allowed to say that. Can I say that?
I agree with you.
I think we're better problem solvers, and you've got to hold a lot of information in your head to be able to address something like this across, you could be a commercial lawyer, but you're having to think about commercial law, regulatory law, IP law, and you've got to hold all that information to be able to even give initial indication of what might work, what doesn't work before you bring in your colleague. The same in tax. We particularly, most projects are in multiple jurisdictions. There's a corporate, there's founders, there's almost like there's tokens like share incentives. You have indirect taxes like VAT, payroll. So you have to understand you have to have an awareness of multiple taxes across multiple jurisdictions and just build up that kind of knowledge and effectively problem solve it before you then bring in the relevant people. And I think women are very good at doing that.
Definitely. And I'd agree with you. I think especially people that aren't that mature in their careers, because a lot of people are sort of settled. I'm not going to learn a whole new industry now.
Yeah, exactly.
Both of you guys sort of learned this industry, and there wasn't a course, wasn't one specific book to read, etc. How did you guys almost upskill, and what do you do to stay up to date? Because this industry is always changing.
Yeah.
It's a good question, isn't it? I would just say by being fully immersed. Like, I think I'd say it is a luxury. This is all we do day in, day out. So we're not doing this on the side of doing whatever else. And I think as a result of that, the people that we surround ourselves with, and that is clients, that is intermediaries, that is other people working in this space. Don't get me wrong, with the pace of change, I think there's always this fear that something's happened and you're not quite on the forefront of it, or perhaps whether that's true or not. But yeah, I think it's just full immersion. I think it's...
Yeah. I think, we, as you said, we're full time in this. So late 2019 for me. And then we have a team of people who can kind of deliver the work. So I get to speak to people. I'm speaking to clients, intermediaries, meeting people, and we're learning through conversation. So something will come up like the Cipher Trace thing last Friday. They pulled certain products. I was on a call and I was like, oh, wow, this is going to be an opportunity for one of our clients. Let's introduce them to some of the people on the call who were using CipherTrace. Without that call, I wouldn't have picked that up. And I think, it's just speaking to people.
Yeah, and just to add on to that, I think it's also the diversity that we have within our team, the work here, because we're all responsible for working within different aspects of what we do. So, I'll learn a lot from you in terms of what's going on internationally. We've got other people that feed into the team in terms of policy. And because we're all involved in this space, we've got things going around about the Solana meme coins at the moment. I think because we just have that space for ourselves, we do actually complement our own knowledge bases just by virtue of being passionate for this space.
I think it's cool to see, because in this space you have to be in it. It's like the fact that you know all the Solana meme coins, everything that's going on, means you're thinking about it, seeing what's going on, because that's where I think especially tax practitioners, lawyers really add value. Is when you really understand the underlying. You can take traditional principles and apply them, but you need to understand nuances. So let's get into the tax side, because I know there's a lot to discuss here. I mean, so you were saying, you talk to clients, you go through everything. When you're talking to clients, especially on the tax side, what are the things that you see them missing almost from the start? So if someone's starting out a project, what should they be thinking about?
The most common thing that we see is someone has maybe received legal advice, set up a BVI company to do a private token sale. And they come to us and they're the directors on the company. So they've just made that BVI company tax resident in the UK. or they're not the directors, but they don't realize that we have anti-tax avoidance rules that will deem all of that profit to belong to the UK individuals personally and taxable at 45%. So they will come to us and they say, we have this structure, we've been told, well, they might be wanting to do something else at that point. And so then I have to explain, actually, you've already got a bunch of issues here. We can't even move on to the next part until we solve them. So if the frustrating part is then once someone's done something, like being able to unwind it is very difficult without incurring other tax charges. Or we can unwind it, but they are paying full tax. Whereas actually we could have maybe deferred tax so we could match it against costs and things like that. So my advice would be to make sure you get tax advice. And actually a lot of projects that we will always give 30 to, usually it's an hour of our time, essentially problem solving. So a project might, if it's a very early stage, it might not be ready to set up the offshore structure. And we would generally give a bit of free advice. So we'll say, you must come back at this point, or definitely don't do this. So we'll always give away a bit of free advice around founder tokens. We're like, you must get your tokens in your hands, or your allocation under a contract, or at least 4 weeks before you have a private sale, and explain all the kind of rationale for that. So yeah, it's taking tax advice, and the key message is it doesn't matter whether in the UK, the US, Canada, Europe, you cannot set up a company in a tax haven and own it directly without being personally subject to tax on it.
We'll get back to...
Sorry, I was going to say, or if you have an onshore devco and it sets up a subsidiary, that onshore devco is taxed on the tax haven.
No, definitely. We'll get back to the tokens for the team, because that's really interesting. But with sort of offshore orphaned structures, what are the benefits there? And maybe just for people who don't know what an orphaned structure is, what is it and why is it useful to have those?
So an orphan structure is essentially one that's owned by no one. It could be a foundation, it could be a company limited by guarantee, or you have as you know, the Cayman Foundation company, which is a blend of the two. Although generally we would just treat it as a guarantee company. If there's lots of different benefits. There's tax, and then there's commercial. So a lot of people like the foundation because it looks like it's controlled by no one. So no one, it's absolutely entitled to its profits. You can't distribute them to the founders. And so it almost mimics what you're trying to achieve with a DAO. And yes, it has a board of directors that are making decisions, but you can also give power to the token holders, and the directors then can administer those decisions. So it's if you have a DAO without a legal wrapper, you're into a bunch of tax issues for the people that set it up, for the token holders, potentially treated like a general partnership. If you put it inside a legal wrapper like a Cayman Foundation, you remove all of those issues. So the starting point for setting up something like that has to be commercial. There are then certain tax benefits depending on which jurisdiction your devco or labco is in. So if the devco is in the UK, and no one from devco is on the board of the foundation, they are not related parties for tax purposes. That means whatever you agree for services, whatever price you agree is by definition arm's length. If you've got a Cayman entity, Cayman Foundation, maybe with a BVI sub, and you've undertaken a token sale, you've raised 30 mil, none of that is taxable in the UK unless you bring it back into the UK. So you would have service agreement, let's say it's cost plus 10%, and that should only be taxable on the 10%, the UK company on the 10% markup. That doesn't work for all jurisdictions. So a lot of European jurisdictions will deem that, let's say Portugal, you could have a Portuguese labco, Cayman Foundation, just by the mere fact of a service agreement makes them related parties. And so then you would have to do a transfer pricing study to then price what should be paid under the services agreement. And then the question is, should that be cost plus? Should that be profit split? You can usually get to cost plus, but you need to have some substance in Cayman, or at least within the structure, even if it's not Cayman itself. So that can be a nice benefit. Essentially, it's tax deferral, but it doesn't work for every jurisdiction.
I think that's what makes what you guys do so interesting is most of these teams are everywhere in the world.
Yeah.
So yes, you might have an orphan structure, but it's dealing with different entities, different countries, different individuals, different countries.
Yeah.
So
it's so fact specific. I mean, if you had, I don't know, let's say there's a UK DevCo, but you've got founders in Canada and Australia, you could probably make that work. If you've got a founder that is in the UK, but is a US citizen, depending on their percentage of ownership of the UK company, they could end up being related parties, and we'd have to bring everything from Cayman back into the UK. So yeah, you could have a US person that's not in the US with a UK DevCo and a Cayman foundation, and then still end up with him potentially paying tax personally on the whole lot. So it's very fact specific. And there is, and the founders are never just in one jurisdiction.
Well, I mean, it's the nature of the industry, and people travel around a lot as well.
Yeah.
So, I mean, you're busy talking about founders. I think one of the things I see a lot as well is founder allocations of tokens.
Yeah.
And sort of the valuation point for that and the timing mismatch.
Yeah.
What have you guys seen there? What are some of the major issues? And Ben, maybe from your side, valuation-wise as well. What makes it tricky in crypto?
The first major issue is founders doing a private sale and then not having their own allocation.
Because as soon as you've got that, you've got a value to the tokens.
Yeah. So if you have a founder, so you've done a private sale and the founder hasn't got their agreement, and usually they've raised some money and they've come to us because they've got money and they're asking to do some tax structuring, and we're like, do you have your founder agreements in place? And they say no. So at that point, we then have to look, let's say you've got 20 cents a token at that point. If they don't pay 20 cents a token for their allocation, they will be subject to income tax or a dividend in kind, so dividend tax, on the entire value of their tokens. So if they had 100 million tokens, it's 100 million at 20 cents, and then subject to income tax. So then at that point, we have to look at, can we defer? If that's happened, then we have to look, can we defer the tax point? Because if they then enter into a contract, say before TGE and the value is 20 cents, the income tax charges at that point. So then we want to draft their token agreement to defer the tax point until unlock, for example, because then at least when their tokens are unlocking, they can sell the asset and raise the cash to pay the tax liability. That's the biggest issue.
Yeah, absolutely.
It's a simple solve.
Yeah.
Do you want me to go on? Or whether you want me to ask a question?
Ben, from a valuation point, what do you see with teams in terms of, even if it's for token generation, if you put on your accounting hat and how you do evaluation of that? I know you're not a valuation.
I'm not a valuation specialist, but if I'm qualified to answer that, if I'm being honest.
But you guys have sort of in-house valuation experts.
Yeah, I tend to work with them probably more than
Okay.
So the simplest approach is for founders to have their allocation before there's any value. But how do you? They still need to pay the market value for their token, because otherwise, depending on the jurisdiction, there's a bunch of anti-avoidance rules that could convert their gain when they sell into income. So that's a nightmare. So the simplest thing is value the tokens and pay that value for them. So the question is, how do you value the token when there's no comparator at that point or no third-party value? So the approach we would take very broadly, there's a lot more that goes to it, and I'm not the valuation guy, so I'm going to caveat that, it's a cost-based approach. So we look at all the costs to date, divided by total token supply or expected total supply, gives you a price per token. And then the founders can buy their tokens. And usually it's at 0.00 something if it's early enough. Different valuation firms have a different view on what costs you're allocating. We generally take the approach that it's all the costs in relation to the token and potentially the IP, depending on the project. Other projects will include much broader, other valuation people include much broader cost base. But it solves everything. So then you have paid the market value, you don't pay tax again until you sell them. In most jurisdictions, some jurisdictions will ignore that contract, like Slovenia, as we were saying earlier, and they will just treat TGE as the time of the tax point.
No, very interesting. So, I mean, we've covered the beginning. So setting it up, token allocation, everything else. When these things start operating, you've got your orphan structure, wherever that might be. You've got your labs company. What are the things the team should be looking out for in terms of sort of day-to-day operations after things have been set up then, from a tax perspective? I know we have limited time. So.
Well, I was going to jeopardize that with almost like an accounting finance.
You go with accounting, and then I'll do
there's so much for day one if we haven't sort of probably iterated that point enough. It is, if you look in the wake of FTX, how did they get to that point where actually, you've got someone going in from the liquidator's perspective going, there's no discernible financial function operating here. I think the difficulty with this space is often we see founders who are fantastically technically minded, and as they were saying earlier on, in terms of start considering tax from day one, it's that, or in fact earlier, a lot of this is often driven by regulatory pressures or various other things that people are obviously focused on in terms of how to get their project started and going. But then when we need to start thinking about, right, well, actually, what does your finance function look like? How are you capturing data? What are you doing with the accounting, bookkeeping? Do you have multi-sig wallets? Who's in control of this? How are we capturing all of that data? Because there is obviously the ongoing tax piece around that. But often that can be overlooked as well. And we often see a lot of projects where actually they've got a lot of developers. They are constantly looking at how to adapt and evolve their projects, but actually, due to either funding elements or just not being considered, is the financial package. It's actually like, where are we? And that then covers a lot of other aspects as well as just meaningful financial data from a business perspective to understand what your spend is actually, what are we spending on developers, improving the software, cost of our intangibles, all those sorts of aspects that goes with it. Sorry, it's starting to turn into a rant, so I thought this is looking ranty. But it is, certainly depending on the size and growth, you're going to want to have those systems and procedures in place to understand how you're capturing that data, who's making those financial decisions, where are those financial decisions being made, and all of that from day one, as well as tax implications. Sorry, I probably spoken a bit too long, but that kind of... Yeah.
So I'll cover it from a tax perspective. We definitely don't want anyone from LabCo on the board of the offshore entity. Even if you had one person, this is ideal. We appreciate that some people do go on the board. Even if you had one person from LabCo on the board and you had, say, 2 Cayman directors, so you have a majority there. If in substance the LabCo director is making all the decisions and he's in Canada or the UK, he will bring that company into the onshore tax debt. Also, if they're on the board, you can bring back into play the related party rules, which will make you bring all the profits back into the onshore jurisdiction. So our recommendation is don't have anyone from LabCo on the board. Naturally, they're going to be very anxious that then you have a board of directors that you don't know who are, effectively holding like potentially billions of pounds of assets. And so we would always recommend having at least 3 directors on the board, ideally across 3 different firms. And we would then make sure that there's a good structure around multi-sig. So one of the big flags for bringing a company onshore into the UK or other jurisdictions is control of bank accounts. So if you had offshore board doing everything, but you had someone in the UK controlling the bank account, that would be veto, your tax resident here. That's like a primary flag. And so then we have to overlay that with wallets. So if you've got someone in the UK controlling the wallet, that's going to indicate that, they have the control of the most important thing, the funds and the tokens. So that will bring it into the UK and other high tax jurisdictions. So you would need to have a multi-sig, and the people in the UK could only have power to, say, set up payments. Like we wouldn't want them approving them, and then you would have to have the offshore director or administrator doing the kind of payment approvals, and that's to demonstrate that they are actually the ones making the decisions to make payments. So once you've got the offshore board, you then have people in the UK, and it's making sure, or UK or other high tax jurisdiction, US or Canada or wherever, they need to interact with the board in a way that is making recommendations, not instructions, and they cannot usurp the board in any way. There has to be a paper trail showing that the board has considered the information that's being given and then make the decision to proceed with a transaction or engaging a particular exchange or a particular service provider. you can delegate some of that if the board sets some parameters. So if the board says, look, we want you to go and negotiate the private sale, this is the parameter in which you can negotiate price, that would generally not bring the board on the offshore entity on shore. But if then there was a particular discussion with an investor and they wanted to go outside those parameters, the onshore entity would have to go back and say, look, this is the discussion. What do you think? Is this something you're willing to do? And the board needs to have the experience of the sector to be able to make those decisions, not just rubber stamp the information coming from.
And perhaps up-to-date financial information.
Yeah.
To make your decisions. I mean, I see that day to day is making those decisions, having those conversations, and then documenting everything. It's really operational. After you've got structuring set up and everything right. Sort of running it day to day, working with the team, helping with those decisions. It's really interesting, but it's challenging as well because each project is so unique.
And there was a tax case recently. So our law on corporate residence it's not codified. It comes from case law and it goes back almost 100 years. I think it's 100 years now. We had a case in the last, 3-4 years. And it pretty much turned, I don't think the result was right and it never went to Supreme Court. But it pretty much turned on a set of notes that an EA had taken of a meeting between it was a property transaction, but in this scenario, kind of Labco and Cayman Board. And the EA wrote the word instruction, that so-and-so instructs. So Labco instructs Cayman, and the case pretty much turned on that point that they were instructing the offshore entity to do something, and therefore they were controlling it.
That's very interesting.
So. I think it's bad case law, but it didn't get appealed. So unfortunately, it didn't get overturned.
Awesome. So you just you touched on corporate residence there. And one of your articles, or one of the points on your bio was talking about DAO voting and the impact on corporate residence. So can you maybe explain what the potential impact there is?
Yeah. So I really picked this up as an issue for projects that were trying to be decentralized on day one, but they didn't have, so the people that held the tokens were the founder team, and they were making decisions with their tokens. And they didn't have a network of token holders at the time, or they didn't have a big enough network. So they were essentially swamping the decision making. So if the protocol is in the foundation and the decisions are affecting the business of the foundation, and they're making that decision with their token, and they're sitting in Germany, then in my mind, they're controlling that the mind and management is in Germany through the token. So it doesn't happen very often because usually you won't see founders using their big allocation to make decisions, because usually there's a full community of token holders. So you wouldn't want to see a founder kind of overriding the rest of the token holders. But for a few projects, we saw that issue, and that one was in Germany. Now, the German tax authorities, or most tax authorities, probably shouldn't single out Germany, are not necessarily looking at token voting. But at some point in the future, corporate residence rules will have to evolve to look at who are making the decisions. Because if you have, a fully decentralized project with the token holders making the decisions, and the directors then at that point really just being the administrator, then the directors aren't exercising, central management and control. Well, there isn't central management and control is the point, but you have this decentralized organization inside a legal wrapper, and tax law can only think about it in the context of, there has to be a central management function. So I think they would then look to, okay, where is there a dominance of token holders? So if that is more likely in most of the projects we work on at the US, but and the US doesn't have corporate residence rules, thankfully. But if it were in the UK, it will absolutely come that there will be a UK tax case or an ECJ case that looks at decision making through the tokens, whether that's corporate residence or permanent establishment risk.
No, that effective control is a very interesting question.
Yeah.
And especially in a pseudo-anonymous blockchain-based world, how do you figure that out?
Yeah.
The founder example is perfect because there it's very easy to point to, you swung this vote.
Yeah.
And I've seen this where we've had votes where you've got a low token holder turnout, and one of the founders voted on it. We sort of reached out to them and said, listen, we need to rally the troops here, get some more voting going.
Yeah, I mean, if they did that 4 times in 1 year and they're in a jurisdiction that has corporate which most jurisdictions do, that would be, I mean, all it takes is a smart tax inspector who understands the space to, which there aren't many of at the moment, and we hired the one that was HMRC. It won't be long.
Well, I mean, you sort of just covered HMRC. I know you've worked with the Law Commission on their DAO section. You've worked with HMRC.
Yeah.
What are you sort of seeing on the regulatory side? The regulators sort of upskilling? Are they understanding the space better?
That's a good question. So Dion Seymour, he was head of crypto at HMRC. He joined us 18 months ago.
Yeah.
And he's responsible for all our policy work. So he's linking in with the current government via a particular trade body, discussions with kind of ministers on the shadow side. And he does a lot of the work with the Law Commission.
The FCA got a bit more SEC-esque, didn't they, after the financial promotion rules, and actually did start targeting crypto businesses that it would seem they perhaps did not want to be operating in the UK. And actually we started to get more of a sort of an enforcement feel. I do think they're having to come round to it a bit more than perhaps we've seen recently. Obviously, we've just had ETNs approved for professional investors, no doubt in the wake of what's been going on in terms of ETFs being approved in the US. I personally am probably not as connected to that side of things to provide more commentary, but I feel like it's a space that I think they're warming to the idea of this becoming something that they do need to get more of a grip on. But further detailed analysis,
and I guess we have the change in government potentially coming up. I mean, we're going to have a change in government in May or whenever it is. Now, the FCA is independent of government, so it can't be told what to do, but can potentially be influenced. Yeah. And at the moment, the Labour, the likely party to come in, haven't stated their view on crypto, because it's not going to be an election winner, and they're going to have so much to do when they come in. They don't want them to be held to it. But so the current government is much more business focused, and that's probably that's this whole kind of make the UK a crypto hub. FCA has been kind of protecting retail focus, and then the new government coming in is likely to be much more retail focused. They're about the people. So yeah.
Just personally, and disagree with me if you should otherwise, like I feel it's where we started off probably pretty cold. And actually we had a lot of businesses leave the UK as a result of the FCA registrations and how difficult it was to actually become registered with the FCA. I feel like we've moved on from that place and it's slightly warmer than it was, but we're nowhere near where we need to be actually be this crypto hub and actually facilitating businesses within the UK.
Yeah.
No, I think that's generally what you're seeing is everyone's figuring it out. And it's a tough space to wrap your head around and then actually write legislation. Because you have this sort of push-pull between growing industry, etc., but also protecting retail.
I think we'll probably see some, I don't know if you agree, some changes once the crypto asset reporting framework comes in.
Yeah, agrees. Yeah.
So I don't know if you're familiar with the crypto asset.
I mean, it'd be interesting if you go, I know of it, but it'd be really interesting to go through it, yes.
Have you come across kind of the common reporting standard and FATCA? So essentially, the best, I think the layman's way of describing it is the crypto asset reporting framework, or CARF, is the crypto equivalent of CRS and FATCA. The main difference is that the US doesn't have CRS, it has FATCA, and the US will adopt CARF. I think 26 countries, maybe more, have said they will adopt this CARF. And so by 2027, it will be effective in all those countries. And what that means is any kind of crypto, CASP or VASP or whatever definition you want to use, will have to collect information on the users of that. It's so broad. I think it's as broad as the FATF definition of VASP. Will have to collect information on users of their platform. So if you're a DEX wrapped in a Cayman entity, and you've got a bunch of user traders, which are not KYCing, they will have to be KYC'd, and that information will have to be reported to the Cayman Tax Office, and the Cayman Tax Office will automatically exchange it with whichever country those people are resident in. So kind of 2025, 2026, most projects are going to have to start building that capability in, so they're ready for the first exchange of information share in 2027. So I think 2026, most jurisdictions will have brought it into law, but the first exchange will take place in 2027. So 2025, people are going to have to start building that in and educating their users. So I think once that happens, and everyone is having to KYC, there's literally no, there's going to be almost no jurisdiction that you can go to to avoid this. Cayman have said they'll adopt it. BVI.
And it's quite interesting as well, because it's, unlike the common reporting standard, which basically says like this is the position at this point in time, actually the CARF, it's transactional data.
Yeah.
It's actually all the transactions that have happened with those. So the tax authorities are going to be getting a very detailed, absolutely, analysis. And then that, from a tax, I know we sort of started this with a reg perspective, but actually from tax authorities understanding this data, inquiries, investigations, everything else that come with that, they are going to be getting so much more data than they've ever received on taxpayers' positions. Which is going to be...
And then I think from a regulatory perspective, if projects are forced to collect that data, then they're going to be meeting the requirements for most regulatory jurisdictions. So most like highly regulated jurisdictions. So I think 2027 and this CARF is probably going to force that collection, which will make it easier to register in places like the UK, subject to the FCA's capacity to register everyone. And there's no carve out, there's no de minimis carve out, there's no NFT carve out. We were on a lot of the calls with the OECD to try and influence this. And my perception was that when they were creating CARF, they were thinking about it in the context of centralized exchanges only. They weren't thinking about kind of more niche projects or NFT projects. They were absolutely not interested in including some form of de minimis or like in-gaming NFTs. I mean, in-gaming NFTs would be caught by this. 250 quid, 100 quid NFT. You have to collect the data on the person and share it.
It's going to be interesting to see. I mean, it'll be interesting we've seen the space mature. So I don't know if by that stage we'll have that, and we'll have on-chain identity, soldo and tokens, whatever it might be. So we might have technology solutions that actually do that. And you can use Zika or whatever to protect identities. So, but 2027, I mean, it's far out, but closer than you might think.
It's not that long.
No, I know. Clearly 3 years, God, but it's before we know it.
No, I mean, that's a really interesting one. And that might actually impact the regulatory side, because you have to comply with that. The regulatory side is also easier. Cool. So I'm going to take it away from the serious stuff. You mentioned...
Do we have any non-serious?
Your LinkedIn is always full of fun stuff. Mine's so serious.
Well, I mean, you mentioned NFTs. I mean, digital land is very interesting. What is the how should people think about NFTs, digital land, even just personally? In dealing with that?
From a personal tax perspective, if they're investing in it, or
generally,
corporate, I mean, you can pick up the personal, but I can talk from a.
I mean, it's still. I thought it was.
Sorry,
no, it was fun. I'm like, don't make this fun. I mean, it's the ownership of digital land is going to be an asset like any other. So it's from a personal perspective, it's under the same sort of tax rules as it would any other form of digital assets. I mean, I'm trying to think what we could talk around that isn't sort of tax related from a digital land perspective.
Yeah, I think with NFTs, we have to look at what the underlying asset is. So if it's digital land, then it's, essentially IP. So then what's happening with that IP? How's it being exploited? So are you leasing that digital land? Well, it's not really leasing, as in like renting the digital land. You're actually, what is it? It's a license. You're licensing someone the right to do something with your IP, build on it. So then you potentially have royalty income. So most countries will require you to withhold taxes on royalty income. So I don't know, let's say you own an NFT over digital land, you let someone in the UK build on it, and they have to pay you a fee. Well, that fee is a royalty, and it's subject to 20% withholding tax, and the person paying it has to collect the tax and pay it over to HMRC. And most countries will have a tax on that. So I think whatever, you have to forget that it's an NFT and go back to what's the underlying asset, whether that's digital land, whether it's real estate. So we're looking at tokenizing real estate at the moment. So what are the tax consequences? Do we have, do we have capital gains tax when we sell the NFT if someone's non-resident? Can we mitigate stamp duty? Can we mitigate stamp duty reserve taxes?
And it all comes down to, again, as you were sort of saying, the definition there of what the NFT actually entitles you to. Like, how closely is that linked with the underlying asset and various other aspects that then have to consider the taxes that then apply to the utilization of that NFT.
It's the point you made earlier. You have to go back to first principles. Like, what instance is it? And then you overlay the tax law. Which is why we always kind of laugh, like, not laugh, but like, people don't get crypto to crypto transactions are taxable. I mean, I was just going to say about the dad, he's not going to see this and see. One of my daughter's parents was at my house a couple of days ago. And he was like, so I made a load of money in crypto, and I transferred it into USDT because I don't want to come out of crypto because then I got to pay tax. And I just stood there and looked at him, and I was like, "How much did you make?" And I was like, "I don't know when to tell him that actually all of everything he's done is taxable." But we laugh because going back to first principles, which is you have one asset, you sell it, you buy another asset. So there's a gain, you pay tax on it.
And certainly when it comes to land, obviously you've got potential indirect tax consequences. Electronically supplied services actually is what you're doing within that digital space or the provision of land. Is that amounting to a supply that actually we need to consider for VAT? And if so, where's the supply taking place and who are you interacting with, and all of these things that potentially come into the mix as well.
So that's a really good point, because a lot of projects, I wouldn't say avoid VAT on NFT transactions. It's more that, so a lot of them will say just sell through their website and they're not collecting, or they haven't traditionally collected data. So if you don't know if you're selling an NFT and it's just an image, our view is it's an electronically supplied service. So then you're paying VAT if your customer is a consumer in the country that they're located. If it's business, then you forget about the VAT in the overseas country. So if the consumer is in the UK or Europe or Canada or wherever, you have to actually register for tax and pay VAT on that NFT sale. But if you don't know where the purchaser is, how can you assess whether you've broken a VAT threshold? So most projects can't assess whether they've broken a VAT threshold. Therefore, you might argue they can't have broken it if they can't assess it. But once you have CARF in place, you will have to collect all that data. And so you will now have to factor in
IP tracking. If you build a website and I'm ready from the website, actually, is there going to be KYC? E-logging, is it? What's going to be your source of evidence from out?
So the EU said, VAT says you should find two pieces of evidence. You have to have a piece of evidence that's where the consumer is, let's say IP address, and then you have to have a second piece of evidence to corroborate it. So we have had projects kind of do a drop down. So they're not KYCing, but they'll do a drop down and say, state which jurisdiction you're in. But the IP address might be a VPN and say one jurisdiction, or it might be just their actual IP
from
address.
In my country.
And then they've said they're in another jurisdiction, and the two pieces of information conflict.
So I appreciate you sort of said, let's talk about something fun, and then we just carried on.
We went back.
That's why you're on, because I was like,
why can't you get out something personal?
I know. That's why we're
like when we had forthright
going full tax on the answer, but we've ended up there anyway. So
we did the VR thing. What's the VR thing in called?
Oh, I keep forgetting it.
There's a like VR studio.
By Victoria.
By Victoria in London, and we do our team days there. And you basically stand in these pods with a VR on, and you're all in a game together, and you're like running around, and sometimes you run into the wall because you forget you're not actually running. That's a lot of fun.
Nice one. Cool. I mean, I know we've spent a lot of time, so almost to wrap up, we usually wrap up with 2 questions. So I'll ask it to you guys individually for both questions. So in the space at the moment, generally, what are you excited about right now?
There's a lot of buzzwords. There's generally a lot of buzzwords. There's a lot of noise around tokenization. Tokenization of real world assets, I feel, is, for me, that is certainly something that we will inevitably see more of in the next few years, and access, providing liquidity to different markets, and AI. Like we can't escape the elephant in the room, right? It's AI and blockchain are complementary technologies, where we're able to either integrate blockchain as a source of truth for AI data when it comes to deepfakes or any other images where we've got, generative AI happening on that side, or if it's more actually the capabilities of AI solving issues that we're seeing within crypto, like fragmented liquidity and various other aspects. I think those two technologies working together is something that I'm excited to see where it takes both spaces going forwards.
Yeah. Yeah, I would absolutely agree with that. And as a tech geek, the idea, the complexity of those two things coming together and how it's exploited and the different users. I mean, there's so many kind of issues to solve. So
looking forward to it.
Awesome. And then to take the flip side of that, what are you guys scared of, or what are you sort of cautious about?
Probably more ICOs. I mean, since October, we've had a significant increase in projects wanting to launch a token. It's the first time in like a year. And it's trying to work out which ones are just utter rubbish and which ones actually might create something. And that's quite a lot of responsibility, because it doesn't matter how involved we are in the sector in terms of people that we speak to and our clients and our passion for it. It's actually very difficult to know, and I think when you're not a tech person, to know enough to actually work out which are the ones that are going to go the distance.
Yeah.
Some are obvious, but there's a lot that is not.
That's the hype is almost.
Yeah, and I don't want to be necessarily associated with.
No.
Well, we don't want to be associated with scams, obviously.
I think it's fair to say that this space has existed for long enough now for people to have built up a track record in success. So that, in terms of looking at the people behind what they're doing, obviously gives you a degree of comfort. But obviously, there's still going to be new people trying new things each time, and
I would say 50% of the work of the ICO work that we have at the moment is from existing clients that have done a token before, and this is a new project. The others are brand new. I mean, you can generally tell, I guess. Like, we had one recently looking at tokenizing like commodities, and he just didn't want to really take advice, and he was trying to just taking information. And I referred him to someone else, like a tokenomics specialist, and they kind of were like, I said, you need to have someone sense check your tokenomics. This guy went in and he was like, no, this is not someone who's actually wanting to do this for the right reasons.
Yeah, it is, isn't it? And it's I think, as always, it's the current hype that we're in and not quite knowing what might happen next. I mean, whilst I'm sure there were certainly people in the know that might be able to peel back certain layers, say before FTX, in terms of actually what their reserves might have looked like at the time. It's something like that will come along that will shake up the market. Whilst the market, I think, is still maturing, and we're probably in a better place now generally than we've been in the last sort of 12 to 18 months. But it's always that next unknown. And there is, we were talking about it earlier on in terms of protecting retail, and we obviously combine that with like Sol meme coins, but there's still people out there to make money off other people within the space, and it's that side of that that's I don't doubt will take a long time to get away from. I don't know. It's interesting. I was speaking to a guy a while back where he sort of made the point that the SEC wasn't set up because everyone in the stock market was behaving themselves. These things mature over time, and I think we forget how young this industry is. I mean, we're very, very early. We're living this day to day. I think in the bigger picture, it's still very small.
So we'll get there eventually, but I agree with you guys. That's definitely, you see that sort of getting up and people making decisions based on FOMO and hype, not on anything else. Well, guys, thank you very much for taking the time. Really appreciate it. If people want to learn more about Andersen, want to learn more about you guys, where's the best place to find you?
Our website.
Our website? LinkedIn profiles?
Do you want us to say our website, or can you bring it up?
We'll put it in the description, etc. So people can just reach.
Put a lot of content on there in terms of.
Yeah, we have quite a lot of case studies on there. We've got more going up. We actually like to give a lot away. So we'll give kind of a lot of the things like around the founders token. There's a founders token case study. And we say very clearly, get your tokens early. So we do give a lot of away, I think, on our case studies. We also have a crypto tax book that is coming out when I finish it. It's supposed to be out, I think, end of April. It's there. It's really there.
Yeah. Well, awesome. Well, I mean, people can have a look at the website and see all the case studies. It's great that you guys give free resources.
Yeah. And you can pre-order the book on the website as well.
Brilliant. I'll go grab one.
Do you know what? The way we've done it is you've got the tech content and then a case study, and then we apply it to a case study. And it's a case study that starts with, say, like a Web3 project, and then looks at it across their user base and the founders. So it's kind of all linked together.
I mean, that's practical, which is cool.
Yeah.
And I think just from talking to you guys, there's a lot of things that you don't think about.
Yeah.
So just having something practical so you have a frame of reference that you can use and then think about it, that would be very useful.
Exactly.
Yeah. Great. Well, guys, it's been a great time.
Thank you very much.
For having us.
Yeah, thank you.
Thank you for listening to the Decentralized Podcast. I hope you enjoyed this episode. I would really appreciate it if you could like and share this. If you got any value from it or find anything interesting, please just also follow us on YouTube or wherever you're listening to your podcasts. If you want to connect with me, you can just follow me on LinkedIn or Twitter. The links are down in the description. And I'd also like to thank our partner for this episode, Lemma. Lemma assists DAOs and foundation governance companies to do their governance, operations, and all the admin tasks. If you really want to focus on building your community and building the project that you're working on, Lemma can take care of all the admin, all the really boring stuff, so you can focus on the important stuff. You can find a link to their page down in the description as well. I'll see you on the next episode.